If $90 a week sounds too small to build wealth, you're thinking about money the wrong way. Most people assume they need huge salaries or lucky stock picks to break free from the paycheck-to-paycheck cycle. But in reality, it's not about how much you make, it's about how much you put to work. And when done right, that small amount can snowball into something massive. In this video, I'm going to show you and Josh exactly how a simple $90 a week investment into SCHD can grow into a passive income stream powerful enough to surpass your full-time job. I will show you how it works and how SCHD takes the guesswork out. And in the end, I will show you and Josh how to turn $90 into a multi-million-dollar portfolio that pays over $12,000 in monthly dividend income. All right, now that we've got your attention, let's dive into what SCHD actually is. What is SCHD anyway? SCHD stands for the Schwab U.S. Dividend Equity ETF. Quite the mouthful, but don't worry, I'm going to break it down. In simple terms, SCHD is an exchange-traded fund, or ETF, that invests in U.S. companies known for paying consistent dividends. Now, you might be thinking, okay, that sounds great, but what's so special about it? Here's the deal. Unlike a regular stock, an ETF is a collection of many stocks bundled together. With SCHD, this collection is made up of top-tier, financially stable companies that have a proven track record of not just paying dividends, but growing them over time. What does that mean for you? When you invest in SCHD, you're essentially owning pieces of some of the best companies out there. Companies like Coca-Cola, Pfizer, and Cisco. These are companies that make money year after year, and they pay some of that money back to shareholders in the form of dividends. So, in short, SCHD is your ticket to investing in high-quality companies that consistently return value to their shareholders. And with SCHD, you don't have to worry about picking individual stocks or doing a ton of research. Schwab has done the heavy lifting for you, selecting companies that have strong financials and a history of increasing dividends. And for all of this work, they charge only 0.06%. This means on a $100 investment, you would pay only 6 cents. But why do dividends matter? Dividends are one of the easiest ways to passive income and to build a retirement source. And we all love the idea of making money while we sleep, right? Here's how it works. When a company makes a profit, it can choose to either reinvest that money into its own business or share it with its shareholders. If you own a share of the company, like with SCHD, you get a share of those profits in the form of dividends. And it gets even better. You're not just getting a one-time payment. The real magic happens when those dividends are reinvested back into the fund, which buys you more shares of SCHD. This means you start earning dividends on your dividends. The more dividends you reinvest, the more shares you own, and the more money you make in the future. Let's break it down. Imagine you make a one-time investment of $100 into SCHD. At first, it might not seem like much. Maybe you receive just a few cents in dividends. But here's where the magic of compounding dividends starts to take effect. Let's say SCHD has a 3.5% annual dividend yield, meaning it pays roughly $3.50 per year for every $100 invested. If dividends are paid quarterly, that's about 87 cents every 3 months. The key here is reinvesting those dividends. Instead of taking the cash, your brokerage automatically buys more shares of SCHD. Now, because you own slightly more shares than before, the next dividend payout is a little bit bigger. The next quarter, instead of 87 cents, you will receive 89 cents. Then in the following quarter, it would be 91 cents. Not a huge jump at first, but over time, this compounding effect accelerates. After 2 years, assuming a 9.5% average annual return from both dividends and stock appreciation, your initial $100 investment could grow to around $120. More importantly, your dividends are also increasing. Instead of just $3.50 per year, you would now be earning closer to $4.20 annually, simply because your reinvested dividends have purchased additional shares that now generate even more dividends. And because SCHD has a history of increasing its dividend payouts, you're getting paid more year after year. Now that you understand what SCHD is and how it works, let's dive into a critical question. How does SCHD decide which companies to invest in? How SCHD chooses its companies, the secret sauce behind the selection. SCHD doesn't just randomly choose stocks. It's about selecting companies that are proven winners over the long haul. The backbone of this strategy is the Dow Jones U.S. Dividend 100 Index, which sets strict guidelines to filter out companies that don't meet its high standards. The first big requirement? A rock-solid history of dividend payments. SCHD only includes companies that have paid dividends consistently for at least 10 years. This makes sure that every stock in the ETF has proven its ability to generate profits and return value to shareholders, even during economic downturns. A company that has weathered recessions, market crashes, and unpredictable financial conditions while continuing to pay dividends is a company with staying power, and that's exactly the kind of business you want your money invested in. It also focuses on those that grow them. It specifically selects companies that have a strong history of increasing their dividend payouts over time. Why is this crucial? Because a company that consistently raises its dividends is sending a clear signal. We're financially strong, profitable, and confident about the future. This kind of growth is what helps investors generate more passive income each year, making SCHD a great choice for long-term wealth building. Now, paying dividends is great, but SCHD takes it a step further by making sure the companies it invests in are fundamentally strong. It does this by analyzing key financial metrics, including return on equity, or ROE, measures how efficiently a company turns shareholder investments into profits, free cash flow to total debt ratio, ensures that a company has enough cash flow to cover its debts, reducing financial risk, dividend yield, ensures the company is paying out a meaningful amount in dividends relative to its share price. 5-year dividend growth rate tracks how quickly a company has been increasing its dividend payments. These 4 factors are equally weighted in the selection process, ensuring that SCHD is made up of only the most financially stable, high-performing businesses. Another important feature of SCHD is its diversification rules. No single stock can make up more than 4% or 5% of the fund, and no one sector can exceed 25% of the portfolio. This keeps investors from being too exposed to any one company or industry, providing a balanced mix of reliable, dividend-paying stocks. So, who makes the cut? When you look at SCHD's top holdings, you'll find some of the biggest names in business: Coca-Cola, Pfizer, Cisco, AbbVie, and more. These are companies that have consistently delivered profits, rewarded shareholders, and continued to grow their dividends over time. Bottom line, SCHD is designed to take the guesswork out of investing. Instead of spending hours researching individual stocks, you get a hand-picked selection of financially strong, dividend-growing companies that offer both stability and long-term wealth-building potential. It's a simple yet powerful way to put your money to work for you. In the end, I will show you and Josh how to turn $90 into a multi-million-dollar portfolio that pays over $12,000 in monthly dividend income. Why now? Understanding SCHD's current market position. You might be wondering, is now the right time to invest in SCHD? It's a great question, especially when the market is constantly shifting. But the truth is, SCHD's strategy has proven itself time and time again, and the current market conditions make this a perfect time to jump in. One of the best ways to invest without worrying about market timing is through dollar cost averaging, or DCA. Instead of making a one-time lump sum investment, DCA involves investing a fixed amount at regular intervals, such as weekly or monthly. This approach smooths out market volatility, ensuring you buy at both high and low prices, ultimately averaging your cost over time. Let's say you're investing $90 a week into SCHD following the dollar cost averaging strategy. Since SCHD's price fluctuates, some weeks you'll buy at a higher price and other weeks at a lower price. Instead of trying to time the market, DCA ensures you consistently invest, averaging out your purchase price over time. For example, over 5 weeks, SCHD's price might vary. One week it's $28, the next it's $30, then $26, followed by $29, and finally $27. Each week, your $90 investment buys a different amount of shares. When SCHD is at $28, you get 3.21 shares. At $30, you get 3 shares. When the price drops to $26, you buy 3.46 shares. And at $29, you get 3.1 shares. Finally, when SCHD is $27, you purchase 3.33 shares. After 5 weeks, you've invested $450 total, and your total shares purchased amount to 16.1 shares. This gives you an average cost per share of approximately $27.95. Not the highest price you paid, not the lowest, but balanced over time. This strategy protects you from the risk of buying all at a peak price while ensuring you benefit when prices are lower. Over time, as SCHD continues paying dividends, those payouts will be reinvested to buy even more shares, compounding your returns. Now, let's talk about the current economic environment. Interest rates are getting low, and SCHD's dividend yield of 3.58% offers a better return compared to many traditional savings accounts, bonds, or other lower-risk investments. Better than that, it also grows the dividend by 11.04% each year. Even though it is a dividend-focused ETF, it also has a good share price appreciation. In fact, over the past 10 years, it has increased 106% in value, which is an average of about 7.46% compounded annual growth rate. Future projections. Now, based on these metrics, let's take a look at the real potential of consistently investing $90 a week into SCHD and how it can transform your financial future. Let's do the math. $90 a week multiplied by 52 weeks in a year totals $4,680 annually. That's the starting point, the money you're consistently investing to build your wealth. In 5 years, you'll have invested $23,400, and with the power of compounding dividends and share price appreciation, your portfolio worth will be $29,000. In 10 years, with consistent reinvestment, your portfolio will reach $82,000, more than double what you've put in. Fast forward to 20 years, your $90 a week investment would turn into a portfolio worth $378,000. This is where the growth really starts to accelerate. The reinvested dividends continue to buy more shares, which generates even more dividends, and the capital appreciation pushes your portfolio's value up faster. And the 30-year projection is where it gets exciting. By the time you reach 30 years of investing, your portfolio will easily surpass $1 million. Your total investment would be $140,000, but thanks to the growth of your dividends and the value of your shares, your portfolio will be worth around $1,769,000. And after 30 years, you would be receiving $150,000 a year in dividends, which would work out to roughly $12,000 per month. That's more than enough to cover living expenses, and in many cases, it could even replace or exceed a full-time job's income. Want to know how to get paid $250 every week from your first week of investing? Click the video on the screen to find out how.